Substitution into coal. With us is Francisco Blanch. He's head of global commodities and derivatives research at BofA Global Research. And Kevin Book is managing director at Clearview Energy Partners. It's great to have you both here. Francisco, I'll start with you. Are you surprised that crude is back in the red today after what supposedly were going to be some bullish developments here?
Yeah, frankly, it's a little surprising, the sell-off today, but of course, it's in general with the broader sell-off in equity markets and in risk assets. So certainly, I think the oil market remains concerned that the Fed will tilt the global economy into recession by hiking rates as fast as they have and potentially beyond. So, but remember, everything that is cooking in the background is still constructive for oil. So we remain positive and into 2023. We think lower availability of Russian barrels coupled with China reopening. And what we continue to believe will be a Fed pivot in the first quarter of the year will eventually trigger higher oil prices into the summer and second half of 2023.
Kevin, do you agree with that there's still upside for oil prices? Are you surprised that they've been so tame lately?
Well, downside risk because of markets cooling off in tandem or because of recession risk, that's one thing. The cap itself introduces some degree of upside bias. There's frictional supply risk because you have tankers going further than they have gone before. We have a lot of questions we don't know about enforcement, of course. But if folks stay out of the market because they don't want to be in the services market when they don't know that they could be busted for doing something wrong, that could tighten supply. And of course, Russia gets a vote as well. So for all those reasons, it may be that what we saw in the OPEC rollover this weekend was really letting the cap do the work. There's a potential long supply in 1Q relative to the OPEC call. But if the cap is going to push oil off the market, maybe that'll take care of the slack.
And Francisco, where does this leave global supply and demand? How is the price cap likely to work and to affect that balance into next year?
Well, so our initial assumption is that we're going to lose about 1 million barrels a day of Russian oil after February 5. Because remember, there's two stages to the cap. First, there's the crude price cap, and then there is the petroleum product price cap, which kicks in on Feb 5. So we think we'll lose about 1 million barrels a day. We've seen a range of estimates, including the U.S. Treasury, which believe the range will be between 500,000 barrels a day and 2.2 million barrels a day. That's a very big range. It's a range that could make oil swing by $30 a barrel or more. And I think also the other factor is we continue to expect China reopening, which will add about half of demand growth to the global oil market next year. Remember, we do expect OECD economies, namely U.S., Europe, Japan, to essentially add zero, big fat zero to demand growth in 2023 as these economies are going to be bordering recession.
Kevin, now, I find it remarkable how few people actually believe Fed Chair Powell. Like anything that he says about what they're intending to do about rates. What about the scenario, and I understand optimism and all that, where we have a bad economy coming out of Q4 because holiday spending in part is not what people hope it is. It doesn't hold up for the next 3 weeks entirely, and there's no Fed pivot, right? They just kind of keep raising rates and then hold them where they are. What does that do to oil?
Well, fundamentally, crushing the life out of an economy means crushing the life out of oil demand. And if that's how we're going to go, then that's going to be probably pretty bearish. But you have a supply side of the story as well. And so as Francisco is mentioning, there's a wide range of outcomes on the supply side because of the cap. There's still, again, it's important to remember that if you have Russia cutting off gas westbound into Europe, Russia is also cutting BTUs out of the global supply mix, which means that oil could burn to replace that gas somewhere else. More demand there, too. So generally speaking, as dismal and gloomy as it might look, there are offsets on the supply side that we're still watching.
And there we'll leave it. Francisco, do you have a parting word on what you tell American consumers? Should they expect then to be paying higher gasoline prices into next year?
I think so. I think we'll see an uplift from current levels. I don't think we'll see the record prices that we saw in 2022 necessarily, but I do think we'll see higher prices. And also, I'm still particularly worried about energy supplies in the U.S. Northeast throughout this winter. I think it could be challenging to keep the Northeast well supplied, and consumers will have to pay high prices there for both diesel as well as power.
Yeah, fair enough. Guys, thank you. Francisco Blanch and Kevin Book, we appreciate it.
Thanks for having us.